So we are beginning our blocks today, and as you know, we have several chapters that we have discussed, and the first 4 chapters were theoretical. You have the handouts there, you have those notes, so I may not want to or not be able to get into a lot of that, but my suggestion is make sure you get time and go through that. Make sure you get time and go through that. Priska, good evening. So today, I want us to begin with our chapter number 5, which had just a minute. Chapter number 4, we start there, chapter number 4. There is the time value of money. Time value of money. And in the time value of money, we said that a sharing today is better than a sharing tomorrow. And we mentioned of something known as compounding. Compounding is about getting the value tomorrow of the sharings today. We also talked about the discounting. That is about getting the value of the money tomorrow. You get the value today. So we talked about all that, and we had some computations. I give you an assignment, or there is a question that we can look at. There's a question we can look at. Go to this question of May 2018. Go to the question of May 2018. That's where we begin our revision. May 2018, question 4D. May 2018, question number 4D. May 2018, question 4D. The question says that Malta Limited is in the process of completing construction of a greenhouse. The finance manager has estimated that the project's useful life is 15 years and shall generate the following cash flows. We have the years, we have the cash flows. The required rate of return for the company is 10%. So you are told to get the present value of the project. You are told to get the present value of the project. That is what you are told to do. Now, when you are given a question like that, the answer, we will have the year here. we'll have the year. We have the cash flow. We have the cash flow. Then we have the PVIF factor. We are told the rate of interest is 10%. And then N. And then we'll get the present value. We will get the present value. We will get the present value. We'll get the present value. We'll get the present value. So we have the year 1 to year 5. Year 1 to year 5. Zipporah, good evening.
Good evening to you, sir.
Karibu sana.
Asante.
Now we have the cash flow. The cash flow is 5,000. So I would like you to go to your tables. I would like you to go to your tables and read for me. You go to the table, or if you're not going to the table, you use this formula. 1 minus 1 plus r raised power minus n. You divide by r. So go to the tables. Unisome this one. It will be 1 minus 1 plus 0.1. You raise power minus 5. You divide by 0.1. So go to the tables. 10%, 5 years. Can see one from Janet, the others? Someone else to give the figure? Yeah, good. 3.7908. 3.7908. So multiply by 5,000. Multiply by 5,000. Give me the present value. Yeah, 18,954. 18,954. Then from there, we go to 6 to 10. Now, 6 to 10 years, the cash flow is 9,000. The cash flow is 9,000. So if the cash flow is 9,000, now what you shall do for you to get this one, utasoma, you will get the one for 10. So it will be 1 minus 1 plus 0.1 raised power minus 10. You divide by 0.1. So first of all, you read at 10 years. You read at 10 years. Give me the figure. So now this one, 6.1446, as I told you, it is the value from year 1 all the way to year 10. All the way to year 10. But you can see already we have done the one for up to year 5. So to get the gap that is remaining here, you will take this 6.1446, you less this one that you already have factored, 3.7908. That is what I told you should do. So when you less, tell me what you're getting. $2.3538. 2.3538. So multiplied by 9,000. Multiplied by 9,000. Inakuja 21,184.2. 21,184.2. And then 11 to 15. 11 to 15, we have a cash flow of 4,000. So give me the one for 15. Give me the PVIF factor for 15. Higher, 7.60. So 7.6061. So you subtract this one, 6.1446. You subtract the one for 10 years that already we have done. You subtract the one for 10 years. That is already done. When you subtract, what are you getting? $1.4615. So now multiplied by this 4,000. Multiplied by the 4,000. Multiplied by the 4,000. So we are getting 5846. 5846. And when you get the total is the net present value or is the present value. So give me the total of that. That is the total. 45,984.2. 45,984.2. So I think given that question, you can be able to handle. The next question I want us to look at is December 2021, question 3B. December 2021, question 3B. December 2021, question 3B. Now, if you are there, the question says, Sifon Limited borrowed 15 million from Baraka Bank at an annual interest rate of 16%, repayable in 4 equal installments at the end of each year. So prepare a loan amortization schedule. So that question is on loan amortization schedule. Loan amortization. So I told you when you come across loan amortization, the first thing is to get the installment. How do we get the installment? So we say the installment is given as the principal. The principal is the amount that you have borrowed. Is the amount that you have borrowed. You divide by PVAF at 10%, sorry, not 10%, at R% and N years. That's how we get the installments. That's how we get the installments. So in our question here, we will be able to say our principal is 15 million. Our principal is 15 million. That is the amount that has been borrowed. So we will go to the table, the PVAF at 16%. 16% for 4 years. Remember, PVAF is the annuity. So go to the tables. Unisome. And I keep on saying, kama hutaki kuenda kwa table, unasema 1 minus 1 plus 0.16, you raise power minus 4, you divide by 0.16. Either way, you either go to the table or you compute the PVAF. Nisome that value. I'm waiting for that value. Haya, 2.798. Okay, so 2.798. Haya, so divide there. $53.60. 53.60, 588.95. So the next thing is now to draw the schedule. The schedule. So the schedule, we obviously have the year. We have the opening balance. The opening balance. We have the installments. We have the interest. We have the principal paid. And we have the closing balance. The closing balance. We have the closing balance. Then we have the principal paid. So that is the design of the schedule. That is the design of how to draw a loan amortization schedule. Loan amortization schedule. Okay, so I want to believe that we are good. We are there. So if we are there, you begin year one. The opening balance is 15 million. The principal is not the principal, the interest. 53.60, 588.95. So interest, you take 16% of this. 16% of these 15 million. 16% of the 16 million. of the 15 million? $2,400,000. The principal paid is this 53,588.95 minus 2,400,000 minus 2,400,000. You can either write the working there or you just go straight. $29.60, 588.95. That's how you get the principal paid. Haya, tukienda kwa closing, unachukua hii 15 million minus the principal paid 29.60, 588.95. Unachukua sasa hii opening balance, you minus the principal paid. Yes, 12,039, 0394, 11.1. Haya, let's go to the second year. Second year, unafungua na ile 12,0394, 11.1. Higher principal, rather the installment still remains. The installment remains. But now the interest will be 16% of this, of 120,39411.1. So give me the answer to 2 decimals. Let's confine ourselves to 2 decimals. Give me the answer to 2 decimals. Okay, 1926,305. 1926,305.78. So the principal paid is this 5360, 588.95 minus this interest, 1926,305.78. So now we are left with set the figure, set the figure. The principal paid is 34,250.17. Haya, ukikuja huku closing balance unachukua ile opening 120,39411.1 minus the principal paid 34,250.17. Give me the balance. Haya, 86. Oh, yako Janet ndio inafika, tulimaliza huko. 8605. 8605 160.93. Steve, how are you?
Fine, thank you.
Karibu. Haya, so now here we
Asante.
have 8605 160.93. So the installment remains 5360 588.95. So now we have understood the rhythm. So multiply this by 16%. You give me the interest here. Multiplied by 16%. You give me the I've received one. I need another one. $1376,825. 1376,825.75. Haya, sasa subtract this one from this installment. You subtract from that installment. From that installment. Aha. 39,837. 837, 83.18. Haya, closing balance. Sasa utachukua this one. You minus this 8. Aha, I'm waiting for the balance, closing balance. Unachukua hii 39, una subtract hii 86. We, tumekwama wapi? Where is the figure? 4621. 4621. 397.73. Okay. Haya, sasa hiyo ndio opening. Hii ni ya 4. 4621. 397.73. So 5360588.95. So get the interest. 16% of this. 16% of that. Haya, 739, 423. And the others mekwama wapi? 739, 423.64. Haya, so subtract that now. Subtract this from here. Forty-six 21. 46 21 165. Now what we are going to do, because of the roundings, unaona sasa inasoma 165 badala ya 397. Badala ya 397. That difference is brought about by the roundings we have done. So unaandika tu hii ikiwa hivi. 46 21 397.73, so that there you close with 0. So that is what you do. Otherwise, if we were not rounding, if the figures were exact, it should come exactly here to 0. But the difference that you are seeing is because of the decimals. Is because of the decimals. So I believe that now, if you come across the question in loan amortization, you will have something to do and something good. Haya, kutoka hapo, nataka tuangalie April 2022, question 2A. April 2022, question 2A. April 2022, question 2A. Inasema James Chege intends to accumulate shillings 10,000 in his bank account 15 years from now. Required. The amount he should deposit now, assuming the bank is offering a 5% interest rate per annum, compounded semi-annually. So this is compounding. So this question is on compounding. Is on compounding or the future value. So you know the formula, we say the amount is given as the principal 1 plus R u raised power n. U raised power n. And then we said, if we have more than one compoundings, that is M, within an year, or within 1 year, then the amount should be equal to principal 1 plus R you divide by M, you raise power Nm. If compounding is going to be done more than once, within a year, then that is how you go about it. So in our case here, tunaulizwa ama tunaambiwa that this guy would like to accumulate 10 million in his bank account 15 years from now. So we already given this amount here that he wants 15 million. So how much should he invest today? That is the principal. So this one will be times 1 plus R. The rate of interest is 5%. So when you are told that compounding is done semi-annually, how many compoundings are there within 1 year? When you are told compounding is done semi-annually, how many compoundings are those?
2.
2, good. So if there are 2, then it will be 2 times 15 here. So if you want to know the principal, then it will be 15 million. You divide by 1 plus, this should be 0.025 raised power 30. Should be equal to the principal. Should be equal to the principal. So work that out. I have 15 million instead of, oh, ninachanganya 15 na 10. Okay, thank you. Thank you very much, Cynthia. The question is talking of 10 million. Oh, ninachanganya hii 10 na hii 15. Thank you. Thank you very much. Yeah. What is the answer? $47.67. $47.67, 426.852. So that is the amount that that person should invest today. That is the amount that that person should invest today. Now, that is all that I wanted to revise as far as that topic is concerned, time value of money. Now, ukitaka kusaidika, which I know you want, after this lesson, now, uchukue hiyo topic, uisome, we revise, do the questions that we have done. Now, mahali tumekaribia, because we don't have a lot of time, don't do any other question. Jibu zile tulijibu kwa class, na hii sasa tumejibu. So you read like 5 times your topic, ndio uelewe kabisa. Wakileta anything to do with time value, uko sawa. Yeah. So those are the things that we touched in time value. Any concern in regard to that topic? Okay, so if we have no concern, let's cross over to the next that we did after that. And as I said, I may not be able to revise the theory because of the interest of time. Hiyo sasa ni yako. Make sure you set time. Uchukue past paper, one by one. Unajibu hizo theory. Unaangalia wanauliza nini, you go to our notes. Ile hawezi pata, unaweza niuliza. Kama utaki kuniuliza, uulize Google. You have a good base ya kutafuta those answers. So the next topic that we are supposed to look at is valuation models. Valuation models. And in the valuation models, we said it is about determining the value of something. It's determining the worth of something. That's what we call valuation. And we talked of 3 theories. The theories of valuation. We mentioned about the theories of variation. The theories of valuation. And in the theories of valuation, we said number 1, there is what we call the fundamental. Now, fundamental, we said it looks at the characters. It looks at the characters. It looks at the characters of the company. And those are the item that you are valuing. And that is the one that you use to get value when you look at the characters. Then there is another one we called technical. Now, technical, we said it is about looking at the history, the average past values. It looks at the history. It looks at what has been happening, and then you average. And based on that average, you are able to get the value of the asset. Something else that we mentioned is called the random walk. Now, random walk, we said, is about the flow of information. The flow of information. Whereby they argue that if everyone has the same information, then you cannot make a profit. If everyone has the same information, you cannot make any profit. But as long as some people do not have information, then there is an opportunity to make a profit by those who have the information. So after that, we looked at how to value fixed income securities. How to value fixed income securities. And I want us to handle this question of September 2021, question 1C. September 2021. September 2021, question 1C. September 2021, question 1C. Question 1C. So if you are there, the question says, Belta Limited issued a 16% corporate bond with par value of 1,000. The bond will either be redeemed at 20% premium after 5 years or convertible into equity at conversion rate of 100 shillings per 2 ordinary shares. Each ordinary share is currently trading at the Securities Exchange for 50 shillings. It is expected that the share price will increase at a constant rate of 5% each year. So get the minimum, or the minimum required rate of return by investors is what? Is 12% required. You get the current value of the bond. The current value of the bond. So in getting the current value of the bond, we said the value of the bond. Number one, value of the bond. We said the value of the bond, is given as the sum of the interest 1 plus r raised power t or raised power n, however you want to look at it. Let me, instead of using r, let me use kd. The kd, you raise power t, plus m, 1 plus kd, you raise power n. You raised power n. So, let's first of all get the interest. The interest, the int is the interest. We are told that this bond is a 16%. So it is 16% of the 1,000. Tell me how much that is. $160. So the value of the bond will then be given as VB. It is 160. You divide by 1 plus the interest rate. The required rate of return is 12%. So 0.12, you raise power 1. That is for the first year. Then you come here, 160. 1 plus 0.12 you square plus 160. 1 plus 0.12, the third year. Then 160. 1 plus 0.12, the fourth year. We are getting the present values. Plus 160. 1 plus 0.12. That is the fifth year. So those are the interests. They're easy. Then the maturity value. The maturity value is, we are told it will be redeemed at what? At 20% premium. So if it will be redeemed at 12% premium, it will be this 1,000 times 1 plus 0.12. That will be the redemption value. Premium ni kuongeza. Discount ni kutoa. Now 1 plus 0.12. No. Not 12. It is 20%. So this one I'm supposed to add 0.2. Then this one you raised power 5. Alternatively, you can take all these as the annuity, because the constant, you just multiply by one value. The annuity at 5%. I mean, at 12%, 5 years. So either way can work. So this one we are looking at redeemable. The value of the bond, redeemable. Aha, the answer. Umekaa sana. Ama afadhali tungeipitia kama annuity. Yes, I can see. $11.69 from Zipporah. The others? Someone else? Hey, we are taking too long. The answer I have from Priska is different from the one I have from Zippy. So someone else? Yes. So that is the answer that is close. So Zippy, you can check yours. 1257.6 or 0.7. 1257.7. I also have something close to that. Yeah. So that is the value of the boat that is redeemable. Number two, the current value of the convertible boat. Value of the convertible boat. Value of the convertible boat. That's good, Zippy. So the convertible, we will give them shares. So you can get the price of the share. Price of the share, 5 years from now. So we are told that the share is currently selling at 50. So 1 plus 0.05, you raise power 5. You raised power 5. So that is a form of compounding. Ndio tujue that share will be how much? $63.814. $63.814. Good. So we need to know the number of shares. Number of shares. So the number of shares, we are told shillings 100 will give us 2 shares. So now that the par value will be 1,000, how many shares are those? Now that the par value will be 1,000, how many shares are those? So these obviously now will be 1,000 times 2 You divide by 100. That is 20 shares. So if it is 20 shares, so the value of the board should be 20 shares, each at 63.814. Oh, sorry, this is not the, that's the redeemable value. That's the redeemable value. So we'll see, this one, you divide by 1 plus the cost of capital is plus hii ingine tutasema ni 160 times 1 plus, sorry, not plus, minus 1 plus 0.12, you raise power minus 5. You divide by 0.12. So this one we can also do it like this. Instead of kufanya 500 venye tulifanya kwa hiyo ingine, we just do that way. So solve that so that now you give me the value of the board. Hii ni ya redemption, the value at redemption. Yeah, around 1300. Good. So that's around 1300. That's around 1300. So I think there we are good. $1,300. So now you know how, or you should remember how to compute the value of the board, the value of a board. Kuna swali ingine iko hapa ya May 2017, question 4B. May 2017, question 4B. Question 4B. So question 4B inatuambia Rudi Limited has a board that has 3 years to maturity. The board's par value is 1,000. Coupon payment for the board is made annually. The current market value of the board is 120% of par with a coupon of 12%. So you are told to get the yield to maturity. The yield to maturity. Now, the yield to maturity, YTM, we gave a formula here where we said it is the interest you add the par value. The par value minus the current market value you divide by the number of periods. Then the whole of this, you divide it by par value. Par value minus the current market value. Not the minus, but plus. You divide by 2. Then you multiply by 1 minus tax rate. You multiply by 1 minus tax rate. That's the formula that we have in our notes. So if that is the formula, so our YTM would be the interest. The interest is 12%. So it will be 12% of the 1,000. That's the interest. Then you say plus. Par value of that board is 1,000. Minus the current market value. The current market value is 120% of par. So it is 120% of par. Sasa the difference you get there, you divide by the number of periods, which are 3. Then the whole of this, you get the 1,000 plus 120% of the 1,000. You divide it by 2. That way. Now, this question has also mentioned it has not mentioned tax. So that you're getting 0.0. I think it should be more than that. Okay, yeah, it is in agreement. We are in agreement. 0.04848. So that is the yield to maturity. Priska, you can recompute yours. Maybe you did not factor this negative, so you have a higher value. Oh, yeah. So let's see whether we can solve another one here. April 2022, question 1D. Hiyo ndio itakuwa ya mwisho. No, it's 2022. 2022, not 21. 2022, question 1D. So if you are there, the question says, you are on attachment in an investment firm, and the following information regarding investments has been provided to you by a company whose earnings per share in the current financial year was 8 shillings. The company adopts a 60% payout ratio as its dividend policy. Tulikuwa tunasoma mambo ya dividend policy juzi. The company is considering two investment options. One, the firm has an investment opportunity which, if undertaken, the growth rate in dividends will be 10% per annum for the next 3 years. The growth rate will fall to 8% per annum for the next 2 years after the first 3 years, and then stabilize at 6% per annum thereafter. Option 2, the firm can continue with the current investments and the growth in dividends will continue at the rate of 10% per annum in perpetuity. So assuming the required rate of return is 18%, advise on which option is better. Advise on which option is better. So let's start with option 1. Now, option 1, they are saying that the firm has the opportunity which, if undertaken, the growth rate in dividend will be 10% per annum for the next 3 years. So the first thing is to get the dividend per share. The dividend per share. Dividend per share. Now, dividend per share, we are told that the payout ratio is 60%. And the earnings. So the dividend per share is the payout ratio times the earnings per share. The earnings per share. Ndio ujue out of that total earnings tunalipa ngapi the payments. So we are told here that the retention is not retention. The payout is 60%. So that means they will be paying out 60% of the earnings, and we are told the current earnings is 8. So when you multiply that, you are able to know Yeah, 4.8. So now we will have the year here. Now the year, we will have year 1, year 2, year 3, year 4, year 5. We are told that these dividends will stabilize per annum thereafter. So we need to know thereafter. Thereafter is 6th year to infinite. Infinite means hakuna mwisho, forever. So let's get the dividend per share. The dividend per share. So in the current year, the dividend is 4.8. So after 1 year, it will be this 4.8 times, we are told the first year it will grow at 10% for the next 3 years. So this one, 1.1, 5.28. So there are two ways of getting to the next one. You can just take this 5.28 times 1.1. Or you can take this, you square this. So me, I prefer this one. It's also going to grow by 1%. 5.81. Then 5.81 times 1.1. 6.39. 6.39 times, now thereafter we are told it will grow at 8%. So if it's growing at 8%, so it will be 1.08. Imefika huko? Zipi kuna kitu huja multiply vizuri? 6.39 times 1.08 is not that big. Yeah, 6.9. So let's work with 6.9. Then 6.9 times 1.08. 1.08. $7.45. Now to infinite, we will take 7.45. You divide by R. R is 0.18. That's what we are told. The minimum rate of return. And then the growth rate there is 6%. 0.06. Zero point zero six. $62.08. The 2.08. Now from there, we need to get the present value because the question is asking us to tell what is the best option. So we must discount up to now. So we come here and get the PVIF at 18% and N. So go to the table, uanze kunisomea. Na kama sio kusoma, unatumia 1 plus R raised power minus N. Like now, this will be 1.18 raised power minus 1. So get me the value. $0.8475. Give me the next one. $7,182. Next. $6,086. Next. $5,158. Next. $4,371. So the same keys here. 4,371. So let's get the present value now. So you take this, you multiply na hii. 4.4748. Next. Now which is which? 4.1713. Four point 1727. We go to the next. Just use the decimals as they are here, these ones. And then you round to 4 decimals. Next. 3.8889. Next. Three 3.559. Next. Three 3.2564. And the last one. So this one, although we said it is year 6, it is discounted by year 5. It's discounted by year 5. I'm waiting for the value. $27.1352. So total. Get the total. I'm waiting for the total of these present values. I can see 46.487. Someone else? Why are you disagreeing? 487. If you add the way they are, but kama umetumia different decimals, maybe that's why. Okay. So that would be the value of the share right now. Let's see what happens in option 2. In option 2, the price of the share, P naught, he says D naught, 1 plus G, where there is the Gordon growth, then R minus G. R minus G. So D naught is the current dividend, which is 4.8 times 1 plus the growth rate. The growth is, we are growing. At 10%. We are growing at 10%. You divide this by 0.18 minus 0.1. So that is 66. So what do you advise? They should go for which option? Which option should they go for? Option 1. Zipporah, you want to invest your money. You invest in A, you get 46. You invest in the second way, you get 66. Where do you invest? Yeah, in 2. Yes. Yeah. So the advice is that they should go for option 2 because it has a higher value. So we are going to stop at that point. And as I've told you, you can revise that area that you have covered. Hakikisha umesoma kabisa so that uelewe. Then next time tukipatana, tusonge tu hivyo mbele hivyo. And you also continue revising. You'll be so good and so comfortable with the paper when you go to the exam room. I've already said that you also take your own time, chukua your past paper, look at the theory questions. Most of them are in the notes that I gave you. If you are not able to get them there, you can Google. If you are also not able to Google, you can let me know. Yeah, so thank you very, very much for attending. Let's hope to meet in our next lesson on Saturday at 4 p.m.